So hi guys, welcome back. Today we're going to be looking at SoFi Technologies. Just before we start this video, I just want to note that it is raining quite heavily where I am right now. So if you're hearing some background disturbance, I apologize for the video or audio quality. Anyway, so let me get on to the video. So today we're going to be looking at SoFi Technologies. As you can see, the stock has been extremely volatile over the past 6 to 8 months, and we have covered this stock extensively during this period of time. Seeing this stock through its highs and lows and looking at when the stock is overvalued, when the stock is undervalued, and looking at the future growth prospects of this stock. So it all started earlier in June when the stock went to a high of about $23.89. The stock then crashed down to about $13.75 in August. And then since September from September to November, the stock was up close to 60%. And once again, the stock is down about 25%, trading currently at $17.20. So for those who don't know, SoFi is a personal finance company. It provides financial products. It's a fintech company that includes loan refinancing, mortgages, credit card. It helps investing as well, and it does banking through both its mobile app and desktop interfaces. It is looking to get a bank charter soon. And we did cover the bank charter extensively in my previous SoFi video, where we look at exactly how that will affect SoFi's business and the real world implications and the benefits of getting a bank charter. So you can go check that out if you find that interesting and you're looking to invest into SoFi. So today we're going to be looking at why the stock has been dropping, whether this is a big deal or not. We're going to be looking at SoFi's secondary listing, which has once again affected its stock price. And then we're going to be looking at whether SoFi is a buy or not. And then we're going to be looking at some of the deals that they've made with other companies. And then the last thing we'll be looking at is just a little bit of technical analysis before finishing it off. So if you find this video useful, do consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. On to the video. So the first thing we're going to be looking at is this. So SoFi, the shares of SoFi Technology slipped close to 2% in after hours trading as the Social Capital CEO Chamath said that his company sold about 15% of its position in SoFi stock. And then after that, the stock kind of recovered fell about 2% and then recovered slightly, so it was down about 1.5% after this news came out. And this is the big one, is that SoFi Technologies holder SoftBank sells about $22.5 million, 22.5 million SoFi shares for about $486 million. And they basically hold 95.3 million shares now, which is close to 12% stake in SoFi, and they sold it at $21.60 per share on November the 18th. So next we're going to be looking at is this Investor Place article about why this isn't really a big deal as what investors are making out to be. So Investor Place Joel Baglol recently discussed venture capitalist Chamath's sale of 15% of his holdings in SoFi Technology stock. The news, which put pressure on SoFi stock, should matter little to anyone else investing in SoFi, and here's why. SoFi stock is one of many investments. Anyone who follows special purpose acquisition companies knows that SPACs aren't necessarily meant to be significant investments, although they can be for the sponsors of the SPAC. Instead, the sponsors are there to attract other investors and find a suitable business to merge with so they can put the cash raised to work. In the case of SoFi, it merged with Social Capital Hedosophia Holdings Corp. 5 on May 28th, and ETH sponsor V LLC, the partnership between Social Capital, his venture capital firm, and Hedosophia, Ian Osborne's investment firm, raised about $300 million in October of 2020 to put it into play. When Social Capital Hedosophia announced the merger in Jan, its presentation stated that Social Capital Hedosophia, the sponsor, would own 2.3% of the merged entity. However, in private investment in public equity, they noted on page 49 of its presentation, Social Capital and Hedosophia invested $275 million, good for another 3.2%. At the time of the merger, SoFi shareholders own 74.2% of the company. It's those shareholders that investors ought to be more concerned about. Some of other selling stockholders as well. So if you look at the November 15th supplement to its prospectus, you will see that several insiders were selling stock totaling about 50 million shares in a secondary offering. Of those 50 million, Cha SPAC 5 LLC, an entity controlled by Chamath, sold 5.36 million shares in the offering, reducing its stake to 28.68 million, or 3.6% of the company. SoftBank, on the other hand, is selling 22.51 million shares, reducing its stake from 14.6% to 11.8%. However, it is still SoFi's largest shareholder, owning about 3 times more shares. SoftBank first invested in SoFi for the company's Series E funding in September of 2015. SoftBank sees it to invest into large industries or geographies that are ripe for change, says Nikesh Arora, the president and COO of SoftBank Group, in its September 2015 press release. This investment gives SoftBank exposure to the financial services sector, which is one of the largest and most important industries in the world, and SoFi is clearly a game changer in the fintech space. So the fact that SoftBank is selling some of its shares after more than 5 years of holding them should also be of little concern to investments, because SoftBank isn't in the business of permanent holdings. So what actually is important for investors then? The secondary sale of SoFi pushed its shares lower by 12% of its peak, according to investor place Mark Hake. However, he believes that dip warrants a buying opportunity. Hake believes that SoFi stock is worth more than $25 or possibly even more, and currently it's trading at $18 when this article was written and $17.20 as of right now. Analysts on Wall Street are still quite positive of SoFi stock. For example, 6 Wall Street buy-side analysts have written on the stock in the last 3 months, and they have an average price target of $26.33, according to TipRanks. That represents a potential upside of over 29% for SoFi stock, Hake wrote on November the 20th, and since then the stock has fallen even more, so it'd be a greater percentage upside there as well. SoFi stock has traded above $20 since the end of October, but well of its 52-week highs. In early November, the author suggested that several fintechs were going public was an indication that it might be a good time to buy SoFi stock. While November hasn't worked out as the author had hoped for SoFi, I continue to believe that the fintech disruptor will move higher over the final days of 2021 and in the early part of 2022. The company reported a Q3 2021 results that included a 35.5% increase in revenue over last year, and in addition to this, it had a membership total of 2.9 million, which is a 96% higher year over year, thanks to the introduction of new products such as SoFi Invest. And SoFi will continue to launch products that meet the needs of its customer base, now almost $3 million customers strong. And the author continues to like SoFi as a long-term financial services hold. So the next thing we'll be looking at is the SoFi stock, the secondary offering. This is Seeking Alpha article that talks by the Asian investor who's talking about why this is a buy the drop kind of situation after their secondary offering. So just after days about writing about SoFi and the fintech's exciting future in the rapidly growing market for personal finance solution, an even better buying opportunity has emerged. SoFi let the market know that it wants to create a secondary offering. Secondary offerings are done when the shareholders want cash out and use funds to invest elsewhere. The fintech issued a release on Monday saying that SoftBank Group, Silverlex Partners, Qatar Investment Authority, Red Crow Capital LLC, and Cha SPAC 5 LLC or their affiliates want to sell 50 million shares of SoFi in a secondary common stock offering, which calculates to about 6% of SoFi's outstanding shares. So what does this offering mean for SoFi? The important part to understand is that the number of outstanding shares for SoFi will not increase after the secondary offering is completed. SoFi's offering of common stock is different from a capital raise in which companies raise money by issuing new shares and diluting shareholders. This is not the case with SoFi's secondary offering, and the digital bank will not also receive any of the proceeds related to the sale. While the total number of shares is not set to change, SoFi's float is likely to improve as more shares will be available for trading, and the offer created some selling pressure on Tuesday, with SoFi's closing down about 5.5%. The long-term value of SoFi. SoFi is crushing it at the moment. The fintech added 126,000 new customers to reach its platform each month in Q3 of 2021 and grew its total customer base to 2.94 million members by the end of the quarter end. The growth rate in numbers was 96% year over year, but showed deceleration after the COVID-19 pandemic boosted growth from the personal finance platform last year. However, growth rates near 100% are still very, very impressive, and I estimate that SoFi will grow to about 3.3 million by year end. Longer term, I see SoFi approaching a member base in the eight figures, a goal that the fintech could achieve by the financial year of 2026. And the digital bank could grow to 9 million members by the financial year of 2025, based on an annual member growth rate of about 30%. However, SoFi may grow even faster than 30%, and the most recent growth rates were significantly greater. A table below shows SoFi's member growth from financial year of 2018 to 2020, and then adds in the results for the first 9 months of 2021. SoFi's member growth really took off in 2020, chiefly because demand for online banking solutions surged during the pandemic, which condemned many people to stay at home and work from home. SoFi's commercial platform growth is chiefly dependent on membership growth and the rollout of new financial services products such as cryptocurrency, trading, or insurances. Financial service products available on the SoFi platform now surpass lending products like home or personal loans by a factor of 3.1 times, and will likely remain to SoFi's growth for this decade. Here you can see between 2018 to basically from 2018 to 2021, their member went from 653 thousand to about 2.9 million now, which represents a year-over-year growth of 96%, and it has been consistently increasing. Their products as well have been increasing significantly, and the year-over-year growth is increasing there as well exponentially, barring a small slowdown in 2021. Their lending products have started to grow, however, it has started to slow down over the past few years, but 15% year over year is still pretty solid. However, the financial service products have really started to take off, going from about 51 to 3,237, which shows a year over year growth of 179% compared to 2020, which is extremely, extremely solid. Potential takeover target as well. Given its large and growing member base, SoFi could become a takeover target for larger financial institutions, payment service providers, or other fintechs. SoFi's growing personal finance ecosystem, and especially the Galileo brand, which offers financial services API and a digital payment platform to businesses, could make the fintech interesting to companies in the financial services sector that look for an opportunity to expand. Companies like PayPal, Square, or even Stripe might be interested in acquiring SoFi at a healthy takeover premium. Incredible sales potential as well. If SoFi grows its customer base from 3.3 million at the end of financial year of 2021 to 9 million by 2025, the digital bank can be looking at material increases in revenue over the next 4 years. Currently, estimates call for revenues between 3.5 billion by 2025, but this estimate may still undervalue SoFi's growth potential. By financial year of 2026, members should approach the 10 million mark, and the fintech should be solidly profitable by then. Each member generates about $377 in revenue for SoFi annually, and with 9 million potential customers in financial year of 2025 and stable monetization, SoFi can grow to 3.5 billion in revenue quite easily. But if the monetization improves or the member base grows even more quickly, the digital bank could have significantly higher revenues. Because of the drop in pricing on Tuesday, SoFi's sales growth has been discounted by 5% yesterday, and the price of sales for 2025 is 4.9. However, SoFi does not come without its risk. SoFi's secondary common stock offering is not dilutive because no new shares will be issued. However, shares of SoFi went through a drop in pricing because the stock sales by early investors raised questions about a potential overvaluation. SoFi, given the revenue opportunity, is not overvalued, but revenue growth is set to decline post-pandemic. Longer term, the personal finance industry is poised to become more competitive, and only the most innovative companies will survive, and the lack of the moat and revenue slowdown are two things to watch out for. So the big problem with the most recent drop in price has been the fact that early investors are exiting, and you saw 50 million shares were kind of being removed from the market. The reason I don't see this as a problem is, okay, I understand maybe at $22, $23 the stock can be slightly overvalued. But if you look right now, investors believe it was overvalued. The stock came down, and at 17.20, it definitely seems that this is a very fair and, albeit I would say even cheap price to buy SoFi at, given it was trading at $23, $24 just a mere few weeks ago. So I believe, yes, at $25 the stock would be slightly overvalued. I am not as bullish as some certain investors who are like target price of $26. when the market price is about $17.20. So I do believe 25, 26 could be potentially overvalued, and that is why I wouldn't buy SoFi at 25. But when the stock drops to about $17 or $18, I sense it's a very, very good buying opportunity, as the overvaluedness has already been taken into account, and currently you're seeing a very, very good price for SoFi, and I would definitely recommend to invest at as of right now. But of course, make sure to do your own due diligence if you do choose to buy the company. The next thing is that SoFi had a Pagaya partnership. So how best can SoFi keep up its growth ambitions without making a drastic compromising on the quality of its growth? I believe this is one of the areas where the partnership with Pagaya Technologies could make a big difference. Pagaya Technologies is a fintech company that uses machine learning, big data analytics, and a sophisticated AI-driven credit and analysis technology to bolster the broad credit ecosystem of clients such as SoFi. In other words, Pagaya can help SoFi service a much broader pool of clients in a more efficient and well-informed manner. This is a company that has built up a solid competence and decisions in the science space of more than 170 data scientists working solely on research and development. In addition to this, there is also a percentage of network value. Pagaya's R&D spend is about 2 to 12 times higher than what peers such as Upstart and Open Lending indulge in. Pagaya also offers AI services across a range of loan products, of a lot of which SoFi offers on its platform. Legacy credit models and underwriting systems that are prevalent in today's lending industry tend to be rather inefficient, as the data and tech infrastructure trends tend to be very siloed. There also tends to be a lag with the whole underwriting process gets wrapped up, and delays of these sorts can put off prospective customers who could then choose to go elsewhere. With something that like the API plugin that Pagaya offers, SoFi can integrate that credit model with their own decision engine and make more well-informed credit decision with minimum latency. This has the potential to stimulate volumes, as Pagaya track record consists of making real-time decisions where they evaluate an application every second. With such potential efficiency, SoFi is likely to see an upturn in volumes and growth. For what it's worth, Pagaya has a very, very strong track record in engendering a stark improvement in volumes for its client, and this reflected in its retention rate, where it has not lost a single client since its inception of 2016. Basically, after partnering with Pagaya, clients typically increase a 3 times increase in network volumes for half a year, and then a 6 times increase in volumes by the end of the year. Also note that SoFi management on its record stating that they are currently only meeting 30% of the demand that they've got for their unsecured personal loan requests, simply because a lot of these potential clients don't have the requisite credit profiles. So rather than lose prospective clients or turn them away, SoFi can also leverage an AI expertise that Pagaya offers and redirect the clients to perhaps more appropriate fee-based financial products in keeping with their respective credit profiles on the SoFi platform beyond just traditional loans. This is a way they don't lose clients from the word go, and can also avoid unnecessary client acquisition costs later on. Then, with time, as credit profiles of these members improve, loan requests can be reevaluated and granted. And in SoFi's 10Q, I spotted the line: existing members generally experience a higher approval rating than new members, subject to the existing member being in good standards on their existing products. Closing thoughts. The timing of Pagaya technology deal is rather apt at this juncture for SoFi's life cycle, as it will help the latter live up to the investment community heightened growth expectations. If SoFi also gets a bank charter, you can all imagine how well positioned it would be relative to the legacy competition, as it will not only be able to offer loans at a very competitive rates of interest, but it will also be running very efficient and holistic underwriting practice with the support of Pagaya, while also potentially witnessing a very strong growth in its network. So yes, to sum up, the Pagaya partnership certainly makes any long thesis of SoFi even more alluring. So the last thing we're going to be looking at is just some technical analysis for SoFi. You can see the stock has been quite volatile, as I mentioned previously earlier in the video. You can see currently the stock is trading at $17.20 after crashing from about $24.50. I believe at $24.50, I'm not going to lie, I'm not as bullish as other investors, but at $24.50, I believe the stock was quite overvalued. Maybe not significantly overvalued, but quite overvalued. But as I reiterated earlier in the video, the market thought that SoFi was overvalued. The market corrected the stock. The stock is down 25%, and the stock is now trading at $17.20, which I believe is a very lucrative opportunity. People worrying that it is extremely overvalued at 24. sure, that could be true. It could be overvalued at 21, at 20. But when you're looking at a stock trading at $17, a stock that was trading at maybe $24 just a few weeks ago, I don't think it's a very good opportunity. I don't think it's a very good choice to just pass it up, and do not at least try to take this into consideration. And who knows, maybe the stock will drop maybe $1 lower, and that could be another buying opportunity for this as well. So that brings me to the end of the video. I hope you do find it informative and hopefully entertaining as well. And if you made it all this far, make sure to like and subscribe and let me know what you think about SoFi. Are you looking to invest, or what is your target price, and where do you think the company will see? Where will the company be going in the future? That brings me to the end of the video, and I'll see you in the next one. Thanks for watching. Bye.